some of them. So the learning objectives are here. We are going to look at some type of incomes and figure out if they need to be taxed or not. So let's go and see how far we can go for today. One thing that it is important is to understand if your taxpayer that you are preparing taxes, if he's a cash method of accounting taxpayer or accrual method. In general, the cash method of accounting means you recognize revenue whenever you get paid, and you recognize expense whenever you pay for that expense, which most taxpayers might be normally cash method of accounting. But accrual method are those taxpayers who recognize revenue when they earn it. Doesn't matter when they get paid. The moment they earn and they complete the job, that is the moment that they will recognize the revenue. For expenses, they will recognize it as soon as they receive goods and services, and they have obligation to pay for those services or goods. So it's an issue for you to make sure you know exactly what type of client you have. Is it a cash method of client or accrual method? So here says cash basis taxpayers report income in the year money and property are received. Constructive receipt takes place when assets are credited or made available to the taxpayer without restriction. So interest credited to the taxpayer's bank account, that means it's available. Taxpayer report as income the amount of money or the value of the property and the service they receive. Accrual basis normally report income in the year they earn it, regardless of when they receive the cash. They report service revenue in income in the year they perform the services. They report interest in income in the year the interest accrues. They report the revenue from the sales of goods in the year the sales accrues. That means you might get paid 6 months later. That doesn't matter. You record the revenue when you earn it. Although appreciation in property values may cause an increase in wealth, the tax law does not recognize the appreciation of assets as income because it's not recognized yet. It's not realized yet. If you have an asset and asset has been appreciated, that's good for you, but you don't need to pay taxes until one day you sell it. Instead, taxpayers must convert the property into cash. That means you have to sell it or other property before realizing a gain. So a gain will not realize unless you sell that property. Furthermore, only the excess of amount realized over taxpayers' investment in the property, known as basis, count as income. So basis is very important. You need to know the basis of the property that your client has. That might be like digital asset, like Bitcoin, or it might be a car, it might be a house, it might be any type of asset. You need to know the basis and keep record of that basis, because the moment you sell it, the basis will help you to determine the taxes.
I got a question about that though. The profit they make goes into a new home. So they sell house A, they make, I don't know, let's say $100,000 on the equity. But then they buy house B 2 months, same year. And then all the gain goes to the new house.
They have to do 1031 exchange in that case.
Okay.
And they have to have a specific company who does 1031 exchange. They cannot take that money, put it in their checking account. The moment you put the money in the checking account, that's yours already. It's constructively received. You see if you read in the book, it says constructive receipt. So if you sell a house and you put that fund in a 1031 exchange fund, trust fund, and then identify what other property you want to buy, and within 6 months you close that, then it will be tax-free for a house.
Okay.
But if
If
it's your personal house, then you can sell it up to within 5 years. You should be living in there at least 2 years. Within last 5 years, at least you should be in that house for 2 years. And then if you sell that house, you, as a single person, up to 250, husband and wife, $500,000 capital gain will be tax-free. And you don't need to report it. Unless, again, I said, if you receive a 1099 form from escrow.
$150,000 tax-free?
How much?
You said 150,000?
No, 250 for one person, 500,000 for married filing jointly.
Okay.
That means it's a good idea if you buy a house for yourself, live in it for at least 2 years, if not more. And then if you want to sell it and have a capital gain on it, that's good because then it's tax-free. You can buy another house again and live at least another 2 years in it and then sell it again. And then you have another capital gain of tax-free up to 500,000 if you are married filing jointly. So that way you can keep changing your house every 2, 3, 4 years and keep having that capital gain built in your house tax-free. Okay, so, but there is an issue in regards to cash method, accrual method. Here is the exception, I believe. Accrual basis taxpayers normally report income in the year they earn it, right? However, certain advance payments are taxed in the year received. This includes payments for interest income and for warranty services offered by third parties. So if you receive interest income in advance or warranty service by third party in advance, those income has to be reported immediately in that year. Even though you say, no, this is in advance. Sorry, you got it already. It's constructively received. You have to report. It includes most prepaid rent also. There's a special rule that permits deferral of warranty income when the seller of a product provides the warranty. So if the seller of the product provides the warranty, they say, okay, you provide warranty for 3 months for this year. You recognize that 3 months of warranty revenue this year. The rest of warranty has to be recognized in second year. Even though you might say, no, this warranty is for 5 years, doesn't matter. If it's 3 months in this year and you received it, you recognize only 3 months or 6 months or 5 months, whatever it is. But the rest has to be recognized next year. So the length of warranty doesn't matter anymore. But they give you this chance to recognize it in 2 years instead of just immediately and the same year. And that means you have to provide that warranty as a seller yourself. That's the only way you can do that. If the warranty is provided by a third party has to recognize the income, all of it immediately in that year. So here is an example if you like to look at it. So here it says, November 21st, Jenny buys an appliance from ASE, local retailer. She pays $900 for warranty that will cover all repairs costs for 2 years. ASE use a calendar tax year and the accrual method. Since the seller, not a third party, if it's a third party, it's all income immediately. But since the seller offered the warranty, ASE prorates the income over 2 years. In 2021, ASE reports income of 2 months, which is $75, and the rest, $825, will be reported as income in 2022. Okay? Also, accrual method taxpayers may report certain advance payment over 2 years. Income earned in the year the payment is received is reported as income in that year. The rest is reported as income in the next year. Again, this rule holds even if the payment is good for goods or services that extends beyond the second year. So this is 2 years rule. Bottom line, just learn this. This is a 2 years rule. So if you have advance payment from a customer, normally, if it's a cash method of accounting, you recognize it revenue, God bless, right? Everything is revenue. You recognize it, you pay taxes. But if you are an accrual method of accounting company, and you are using accrual method, which you report to IRS on the very first day that you open that company, IRS says, okay, how much of that payment that you received did you earn? You say, let's say 30%. The IRS says, no problem. Record that 30% of revenue for this year. And the rest of it, 70% in year 2. IRS says, I don't care if it takes 5 years to earn it. Let's say construction job. You get $1 million to finish a construction job in 4 years. You finish 30% in year 1. So IRS says your accrual method of accounting, okay, 30% recognized in year 1, 70% in year 2. Even though you're gonna finish the construction in 4 years, but in year 1 and year 2, all the revenue has been recognized for every single dollar that you have been received as a prepayment.
You have to split it in the 2 years? You required, or is it benefit?
That's the way it is. You are accrual method of accounting. You are not cash method. If you are cash method of accounting, you record all $1 million on the year that you receive.
So all advance payments are always split up into 2 years, even if
max 2 years max for accrual method. For cash method is right away. But IRS knows you are cash method or accrual method. You told to IRS on day 1. So they say, no, you got 1 million. If you are cash method, it's income. You pay taxes right now.
No warranty. So the warranty income, that's like you're purchasing a warranty from the seller of the product.
If you warranty, you are purchasing it, then you don't have income. You do not have income. The seller has income.
Yeah, I see. Okay.
Who is selling that warranty to you?
Yeah, the seller is.
Let's say you are representing a tax preparation for a company who is the seller of the warranty.
Yeah.
Okay. Now you have to ask, is this your own company? You produce this and you are providing warranty, or you providing warranty by a third party? If you are a third-party warranty provider, then any single dollar you receive, doesn't matter you are accrual or cash method, any single dollar that you receive for warranty, for selling warranty, you have to recognize it immediately as revenue. As income, yes.
But the accrual and the cash method, that only applies if you have a business, right? Not an individual that's working.
Normally, individuals are cash basis.
Right.
But sometimes you are an individual, but you have a small business, Schedule C,
Right.
and you IRS on the very first day that you put Schedule C in the tax return as a first time, IRS says, okay, is this cash method of accounting or accrual method? Do you have a cost of goods sold or you don't have cost of goods sold? So IRS wants to know all those. What type of inventory? Let's say you have inventory and you're gonna have cost of goods sold. So if you have inventory, IRS wants to know, are you doing FIFO, LIFO, or average? What are you using for your inventory costing? Okay, so employee compensation, normally it has to be in W-2, but if it is income, if it's a tip, the receiver of the tip every month has to report to the employer within the first 10 days of the next month that how much tip they receive. If you receive something like a value, a property, then you can go with fair market value to show how much income you have from your service. Let's say you help someone to do something and then you receive a used car instead of cash. So you have to go with fair market value. And again, here says tips. Here is the tips, says cash tips and credit card tips received from customers or other employees needs to be reported. Employees are expected to file tips report with their employers by the 10th day of the next month. However, employers may require more frequent reporting. Sometimes they say, let us know on a weekly basis. Employers add reported tip income to wages on the employee's Form W-2. So normally restaurants, they pay a small standard pay plus tip. So tip has to be reported so the employer can add it to the W-2 down the road. And because of that, the employer who receives the tip in the December 2021 and reports the tip to employer in January of 2022 will have these tips added to the wages reported on the 22 form W-2. So make sure you report it within 2021 so it can be added to the W-2 of 2021. When employees fail to return in tips report, they must add their unreported tips to their wages in the year they received the tips. So they have to report it down the road in their tax return, unreported tips, which will be let's see. Line 1C, tip not reported on line 1A. Because if it is line 1A, that means it's in your W-2, has a specific box, says tips. And the employer will hold Social Security and Medicare from your tips. But if you don't report it, then employer doesn't know about it. So you have to show that.
Does that mean you end up paying more because they're not paying their half of the, or is there even FICA charged on that? I'm not sure.
I'm not sure about that part. I've never had such a situation myself to be sure, but I'm looking at this form and that's why I want to tell you I'm not sure, because let's look at this form and you will see. It says Social Security and Medicare tax on unreported tip income, right? So you have to report how many places you work, how much tip you received, you didn't report it to your employer, and it will be subject to Social Security and Medicare. So let's go all the way down. And I'm looking here, it says multiply that with 6.2% of social. This is just your half, right? and also multiply that with 1.45% for Medicare. Again, this is just employees half of the Social Security and Medicare. So now I'm thinking, wait a moment, then who's gonna pay the other half, right? I'm not sure, honestly. Maybe someone else can answer that, but I think because on this form, IRS is only collecting your half of the Social Security and Medicare, I'm guessing IRS is not nice, says, oh, don't worry about the other half. I'm thinking he's gonna go back to the employer with a form or reporting or whatever and says, okay, your employee says he received this much tip and he paid his own half of it. Your job is to pay the other half. And IRS will collect it down the road. So that's my understanding, unless someone says otherwise. Okay, so far so good, hopefully. It says if tips are less than $20 a month, you don't need to report it, and you are not subject to Social Security and Medicare anyway. So here says, let's say Rodney works somewhere and he got $165 for the year. 165 is less than $20 a month, right? So it says it's gonna be, he adds this amount to the taxable wage. He pays income tax on it, but Rodney pays income tax on his tip income. He does not pay Social Security and Medicare on that. So if it's a small amount, they're not gonna bother come after you for Social Security and Medicare. And I'm guessing there's a reason behind it, because if they come after you for Social Security and Medicare, then they have to go after the employer to get the other half of the Social Security and Medicare. So it's too much work for something so little. And if tips are more than $20, obviously, you have to report to your employer, and your employer needs to put it in your W-2 and withhold your responsibility of Social Security and Medicare for as an employee, and obviously he has to contribute the other half of Social Security and Medicare, which is 6.2% for Social Security and 1.45% for Medicare. Okay, so we are good. Hopefully here, if there is no question. Okay, so here says, if you are independent contractor and you receive any income, you report it on Schedule C, which we will focus on that in other chapters. But just for now, so you know, Schedule C is for sole proprietorship. If it's a corporation, then you file another separate return, 1120, I believe, and 1120S for S corporation. So in regards to divorce, if the divorce is finalized before 2018, the alimony is tax deductible for the payer, and it will be income for the receiver, alimony, not child support, alimony, okay? But if the divorce is finalized in 2018 or after, the alimony is not tax deductible for the payer, and it's not an income for the receiver. So it's very important when you have a client, you have to ask, when did this divorce settlement finalized. So here is an example. For property settlement, let's say they're getting a divorce. Let's look at the example. Tim and Sher Hudson divorce was finalized during the year. As part of the divorce, Tim transferred to Sher title to the couple's vacation home. At the time of the transfer, the home was worth $250,000. Tim bought the home prior to their marriage. He paid $110,000 for the home. Sher does not report gross income on the transfer. Her tax basis, which is again very important. Remember I said basis is important. So her tax basis in the home is still the same as whatever Tim has. It will be carried over to Sher or the wife. And Sher will use this determine her taxable gain when sometime in future, whenever she sells the property. So IRS is not in hurry to get the income tax from you. It says as soon as you realize that gain, then you pay tax. But for now, it's just nothing. You just carry the basis, whatever the team has. Alimony, I told you already, so we just covered that. Here says after 2018, it's not tax deductible for the payer and it's not an income for the receiver. If it's before that, then it is tax deductible and it is an income. And here says IRS wants you to say who is receiving that alimony, social security number, name, and information. Okay. If it is as a form of tax deductible item and income that needs to be reported, the social security needed for the other part. Okay, let's see what else we have here. Child support. Child support is not it's not the tax deductible item and it's not an income. So Bud and Susie divorced in 2015. As part of divorce decree, Bud is to pay Susie $1,600 each month. The agreement states that $700 represents support for their 8-year-old son. The other remaining balance, which is $900, is gonna be alimony. During the year, Bud pays Susie $19,200, which is $1,600 times 12. Susie reports in gross income the $10,800 she received that represent alimony. 16 minus 7 is 900. 900 times 12, that's the alimony. Bud deducts this same amount from for AGI on his tax return and gives the IRS Susie's social security number. Same fact, except that the divorce decree states that the entire $1,600 payment represent alimony. However, Bud's payment dropped to $900 once the son turns 18. The tax law treats the $700 reduction in payment as child support. Make sense? Because it says son turns to 18, $1,600 goes to becomes $900. So since $8,400 of total payment is considered non-taxable child support, Susie reports only $10,800 in gross income as alimony, but deducts this amount for AGI on his tax return and gives IRS Susie's social security number. So even the divorce says $1,600 is alimony, but the remaining information is denying that fact. Make sense? Because in the decree, it says, as soon as son becomes 18, that alimony is $900. that means it translates to the fact that $700 is child support. It's not alimony. So, but the father cannot say, no, 1,600 is alimony, I'm gonna use it as a tax deductible because it says in the decree it's alimony. But if you read the rest of the information in the decree, it says as soon as son is 18, it goes to 900. So IRS says, no, I don't agree with that. Okay. Now this gets interesting in less other example. Same example, but Bob fails to make two of his required payments during the year. So he missed two payments. Susie receives 16,000, which is just 10 months times 1,600 during the year. Of this amount, 8,400 is considered to be child support. So child support comes first, 700 times 12, no matter what. Whatever is above that, that will be alimony and will be tax deductible for father. Okay? Father cannot say, oh, I'm gonna show all my alimony first. No, IRS says child support first, alimony last. So Susie reports $7,600 in gross income as alimony. But deducts the same amount to the IRS. Same fact as the example 7, except the divorce occurred in 2019. So Bob receives no deduction and Susie has no gross income resulting from this payment. So it will be no income and no tax deductibility. So the date was, what was the date? 2015. After 2018. So anything 2018 or before, it will be alimony and it will be tax deductible. But after 2018, that means starting 2019, that will be non-tax deductible item. Okay, so for IRA, we talked about this before, I remember. If it is IRA, ordinary IRA, you normally put money in the ordinary IRA before tax, and when you receive your retirement at age of, let's say, 65, it will be every single dollar taxable, including the principal and the interest that you earned for that many years of retirement saving account. But Roth IRA is different. Roth IRA, you put money in it after tax. That means when you have a distribution on Roth IRA at age of 65 or older, then it will be no taxation on it. Everything is free of tax. And that's a good thing. So you don't pay taxes on the earned interest that you have on that savings account. But the good thing about traditional IRA is you deduct that from your taxable income first. So you're not gonna pay taxes momentarily right now, but later on, every dollar that you distribute from that account will be taxed.
So in theory, you pay more taxes because the money's grown and the tax rate is higher?
You normally have an income, right, every month. Normally, you need to pay income tax anyway, right?
Mhm.
So if you like to do that, then open a Roth IRA pay for income tax that you earn today
Right.
as usual, like everyone else. But after tax money, whatever you have, put some money in Roth IRA. But when you get older, you get the distribution,
Yeah.
everything is tax-free. So you don't pay for any tax at that moment. And I like that because when you are old, every single dollar is important. You don't want to, pay taxes when you are old. Right now you are young, so you can work a little bit harder if necessary. So here is the a little bit hard part about it. So we need an example. First of all, balance of non-deductible contribution. Sometimes in traditional IRA, you also want to put some money after tax. So normally you put before tax and will be taxed when you get old at your distribution. But if you put something after tax, so that after tax dollar amount goes at the top and value of your IRA goes at the bottom. So you get a percentage, and that percentage of after tax contribution to the traditional IRA compared to the whole value, multiplied with the distribution that you get on a monthly basis or quarterly basis, it will provide you the non-taxable distribution of that IRA, that even though it is a traditional IRA, even though I told you everything will be taxed, but because when you were young, you put some after tax also at top of that. So now you will have a portion of it that is not taxable.
So who keeps track? Who keeps track of that? How do you keep track of every time you put in money after taxes?
Normally, when you contribute on a monthly basis from your paycheck, it will be reported to that institution that this is before tax.
Okay.
And let's say plus $100 after tax.
Oh, it's okay.
So the institution is holding that after tax.
This is if you're doing it through a paycheck, but if you're doing it by yourself, like you've been paid and you're like, oh, I need to fund my IRA, and you're putting money into the IRA yourself.
That's always Roth, because you're putting money.
It's only Roth.
Yeah, normally you do Roth IRA. And I suggest to do that.
But you can't put into a Roth IRA if you make over a certain amount, right?
Even regular IRA, traditional IRA, if you don't have employer plan, then it's $6,000 max you can contribute either to Roth IRA or traditional IRA.
6,000 what?
A year.
A year. Does it so that no matter how much income you have, you can still put in 6,000? I thought.
No, it's not like, don't say no matter how much income you have, because IRS has so many thresholds all over the place.
That's what I thought. I thought like if you made like over 150,000 or something, you could not put money into an
Thank
IRA.
you. But I'm just saying, if you are not, if you are below the threshold and you want to contribute as a individual, it's $6,000, right? So that's all it is. Now you have to choose that $6,000 you want to put it in Roth IRA or traditional IRA. If it is, if you decide to put in traditional, then it has to be reported as I believe in your tax return that this is a Roth, this is a traditional IRA contribution, and in your tax return you reduce your income by $6,000 and calculate taxes for whatever is the remaining.
I guess in a perfect world, you're making enough that you can have both, right? You have a traditional IRA and a Roth, or can you not contribute to both?
But the maximum is 6,000. Now you have to choose where you want to put it.
Then, okay.
It's not like 6 plus 6, 12.
Okay.
It's not that. No, it's just 6,000.
Got it.
But here says, imagine you have an employer plan and you put money in your, let's say, IRA, and you put also a little bit after tax down the road as an extra IRA saving. That's why here says there is a way to calculate how much of that will be non-taxable when you are age 65 and you get a distribution. So let's look at an example so we understand. Over the years, Peter made non-deductible contributions to his traditional IRA, which is normally always you put before tax, right? But he put something after tax also. At the beginning of the year, he had yet to withdraw $40,000 of his non-deductible contributions. At the end of the year, the value of the asset in the IRA was 120. During the year, Peter withdrew $30,000 from the account. Therefore, the value of the IRA was 150. So 120 plus 30 that he took. So that's the total value. Using the above formula, Peter computed his $8,000 non-deductible distributions. So 40 out of 150. 40 was non-deductible, right? That's what he put. Out of total value of 150 gives you a ratio. That ratio multiplied by $30,000 distribution in this year, only $22,000 of the distribution in this year will be included in his gross income. The other $8,000 will be tax-free. Same facts, except that all of the Peter's contribution were deductible. Peter includes the entire $30,000 distribution in his income. So if you put just before tax in your traditional IRA, then every single dollar you take later on will be taxable. It says avoid penalties, which is 10%, by not taking early distribution. So you have to wait at least until age, I believe, 59 and a half. Yes, here, sorry. Here, right there, 59 and a half. This penalty can be avoided if, and this is something important, so try to focus on this. If due to IRA owner's death or disability, those are two important things. If you don't want to pay that 10%, or either die or go disabled. That's what the IRS says, legally. But I don't believe that, because even after you are dead, IRS still says, file your tax return, please. Someone has to do it. Made as part of the series of equal periodic payment over the owner's life expectancy or the joint life expectancies of the owner and owner's spouse. So life expectancy has a table. It says, how old are you? And based on your age, IRS has a table, says normally how many years you probably live. And based on that, it says if you are doing that equal payments over the life, you may skip that 10%, even if you do early distribution. And why is that? Because maybe, I don't know what's going on. Maybe if someone starts early distribution and using that table, IRS says, okay, we go with the table and I waive your 10%. But it has to be according to that table and equal payments. Used to pay unreimbursed qualified medical expenses in excess of AGI floor. So AGI floor is 7.5%, right? So if you have all of a sudden medical expenses above that 7.5% of AGI, and you cannot pay for it, and it's too much to control the finances. So you may take money out of that early distribution IRA and pay for that and skip that 10% by providing probably documentation. Used by an unemployed IRA owner to buy health insurance for the owner, the owner's spouse, and the owner's dependent. Again, if you get unemployed, that's one thing. So those are things that you get questions with your clients. You have to know what's going on and if there is a way to skip that 10% penalty. Used to pay qualifying higher education expenses. So if someone wants to go to university and they have to pay for it, they have no choice. Yes.
Does it include if they pay someone else's, like a grandchild's higher education expenses?
Since there is nothing here to says what, so I am assuming yes. Used to pay expenses as qualified first-time homeowner, $10,000 lifetime limit. So you can take up to $10,000 for your first-time home buying down payment. Yes.
For the AGI floor, would you be able to take out the whole amount over or just the difference between the AGI floor and the actual cost is?
Let's say your AGI is 100,000. 7.5% of 100,000 is 7,500. Your health costs you, let's say, 20,000. So 20 minus 7,500, the AGI floor based on 100,000 AGI. So 20 minus 7.5. You can take up to $12,500 without 10% penalty because it's above the 7.5% of AGI flow. Made as part of qualified distribution by a military reservist call up to activity duty. Again, that's the others. So there are a few scenarios that you can skip that 10% penalty. Other than that, you can't. So I remember I was working in a college that I had retirement saving, and then I was not teaching in that college anymore. And they said, "What do you want to do?" I said, "You know what? Just send me a check." They said, "Do you want to roll over to any other IRA or something?" And I said, "I don't have time for that. Just send me the check." That means I knew I'm going to pay 10% penalty, but it was few hundred, let's say less, about $1,000. I thought, okay, $100 penalty, I will pay for it, no problem. And I have to pay income on that. So not only I paid income tax on that, let's say $1,000 distribution, plus I paid 10% penalty. A penalty is also imposed if the taxpayer waits too long before starting to take and paying taxes on distribution. So this is important. Again, your client will ask you, how much can I wait until I get the first distribution? Or you have to let them know, yeah, you have to do the first distribution. Taxpayers are required to start taking distributions from their traditional IRA when they reach certain age. Before 2020, the law required each person with balance in traditional IRA or other qualifying retirement plan to begin receiving distributions in the year they reached age 70 and a half. So if they reached 70 and a half, they need to take distribution. Beginning in 2020, the age increased to 72. So starting 2020 now is 72. Before was 70 and a half, but starting 2020, it's 72. So if you reach age 72, you have to start distribution. Otherwise, you get penalty on that. A taxpayer may defer the first distribution until April 1st of the next year. This exemption only applies to the first distribution. If taxpayer choose to defer the first distribution to the year after, like April 1st, they turn 72, they must make both first and second year distributions in the same year. For example, a taxpayer who reached age 72 in 2021 has until April of 2022 to make the first distribution. The taxpayer then has until December 31st, like a few months later, to make the second distribution. Because you have to do the second anyway, and you forgot to do number one. So you have time till April for number one, and you have time till December for the distribution for that year, which is number two. Alternatively, the taxpayer can take the first distribution prior to the end of 2021 and recognize it as income for 2021 and spread out the first two distributions over 2 years. Make sense? So the first two distribution, if you take it in 2021, it will be income in 2021. If you don't do that and you take it in April of 2022, now all of a sudden in year of 2022, you have two distributions that will be taxable immediately at that year. Okay, at the time of distribution are required to start, the taxpayer may choose to withdraw the entire balance in the account or start receiving periodical distributions over the taxpayer's life expectancy. Failure to make this minimum distribution results in penalty equal to 50% of shortage. So it's a huge penalty, 50% of shortage. Yes.
So are they required, 72, they have to start making the withdrawals, and if they fail to do that, then they get the 50% penalty, or?
50% of the shortage. Whatever you don't take out in that year, 50% will be penalty. So you better take it or lose it.
Of the shortage?
Of the shortage of whatever you didn't. Maybe you distribute a little bit, but not all of it. You have to distribute a certain amount, the minimum.
And then, okay, so whatever you don't, whatever the difference, that's the
50% of that will go. Taxpayer who reached age 70 and have in 2019 and received distribution in 2020 before the law changed were allowed to return the distribution and avoid tax liabilities. This was a rule unique just to year 2020. Okay, reporting will be on Form 1099-R. You get that form, and normally it shows what is taxable, what amount is taxable, and what amount is not. Taxpayers report the distributions from traditional IRA on Form 1040, including the 10% early withdrawal penalty if someone is imposed to pay that. Okay, so we are good on this, I believe. Okay, now let's go to a little bit complicated part, which is pensions and annuities. Yeah.
Okay, question. Where does the 529 plan fall in this?
529?
Yeah.
That's employee retirement plan, right?
No, it's the one for school, like for your kids.
Oh, 529 for education plan.
Yeah.
That says that under 529 education plan, you can go to an institution like a credit union, for example, and say, I want to open a 529 plan. Cordwell, they call it also something like that, Cordwell, I believe, or 529 or Cordwell. This is almost the same thing. So it's, you put money in it, in a saving account for your child, under your child's name, but you are also on that, your name is on it, but you cannot take it out. So you put everything you can as a saving for your child education until your child gets 18 years old and goes to college. And then you want to pay for the college tuition. You use that money that has grown because of dividend or interest, but anything grows over there is free of tax. So you put money after tax in it, but whatever grows in it, just like Roth IRA, is free of tax. But you have to pay for your tuition. You cannot take money out and go to Disneyland or something. Until you push it all the way to zero and the account is closed. So you just use for education. Pension and annuities. Okay, so retired workers receive pension if they participate in their employees' pension plan during working years. So if I work in Pasadena City College, I have a pension plan. PCC is not, let's say, collecting Social Security. I am contributing to the Medicare, but not Social Security. That means we have a approved employer pension, which I contribute, and PCC also contribute a little bit from his part, and that goes in a saving account and till I want to get the pension one day. Okay, so here is the part again. Many pensions pay benefit for the lives of retirees' spouse as well. Often contributions to the employee's pension plan were made either by employee with pre-tax amount or by the employer. Normally it's both of them, right? So half here, half there. The pension benefits from these plans have never been taxed and are 100% taxable when paid to the retired. However, if any of the employees' contributions were made with after-tax dollars, a formula similar to that used to compute the non-taxable portion of the IRA. So normally it is all taxable unless they put some contribution to it with after-tax dollars. If that happens, so after-tax contribution, whatever it is, divided by number of monthly payment, that will be non-taxable amount. Because it's after tax, you paid with after tax money, so it says, okay, whatever you put after tax, divide by number of monthly payment that it has an expectancy, and that will be non-taxable amount. And it will normally show in 1099, most of the times, 90% of the time. So it's, and if you put it in the software, just put exactly in the same box, taxable, non-taxable. Now here, it says, if the number of payment is fixed, the number of payment is used as the denominator. However, most pension benefits are paid for the rest of the retiree's life, and therefore number of expected monthly payment is used to denominator. So since you don't know how much the person gonna live, so you don't have a specific number, so you go with the table. It says, depends when you start your distribution, 55 and under, you will have expectancy of 368 payments. And the other age are different. Now, if husband and wife, they are two people, then benefits are paid over the lives of both retirees and retirees' spouse. The number of expected monthly payment is determined by couples' combined age. So you combine the age of those two when they start the distribution. And this is also as in the software. So you just, because you put the date of birth, so the software knows how old are they. So based on that, it says if they are 110 years combined and under, they have expectancy of 410 months. And of course, if they have combined higher age, the expectancy will be lower. And that number goes here, number of monthly payment as a denominator, so you know how much of that after-tax contribution will be non-taxable at that year. Make sense? Okay. Again, software will help you on that. It's just math. So there's an example here just to come. On July 25th, Jason, 65, retired and started receiving $4,000 a month from his employer's pension plan. Based on his age, Jason is expected to receive 260 payments over his lifetime. Over the years, Jason has contributed $124,800 to the plan with after-tax dollars. Each month, non-taxable portion of Jason's payment is $480, which is $124,800 divided by 260 number of payments that came from the table, and that gives us $21,120. And because he did on July, so July, August, September, October, November, December, that's 6 months, okay? So 6 months times 480 for year 2021, $24,000 is total benefit, but his taxable is just $21,120 because that 6 months times 480 is not taxable monthly basis. So he pays only taxes for $21,120, even though he received $24,000. He includes the $21,120 in gross income. For 2022, Jason's total benefit are $48,000, which is $4,000 a month times 12. His taxable amount is $48,000 minus 480 times 12. So only $42,240. He includes that in the gross income. Same fact as example 13, except that Jason is married and his wife is age 62. At this time, he begins receiving his pension. So now they have to add it, 62 plus 65. The pension benefit will continue for both Jason and his wife lives based on their combined age of 127. This is expected to be 330 months. So each month, non-taxable portion of the payment is $402.58. Year was 480 non-taxable. Now it's just $402.58. So that's the benefit because they are husband and wife. Therefore, in 2021, taxable amount of the pension will be a little bit less than before. I mean, a little bit more than before because the life expectancy is higher. Okay, so annuities, that means series of equal payments. Sometimes you have, let's say, life insurance that you receive because spouse died and you got a life insurance settlement from. Life insurance is not taxable. So if you receive it, it's tax-free. Then you put that life insurance in an annuity account. And that in the annuity account says, okay, if you put this much in the annuity account, you can get so much, a dollar amount for a specific time period. And you use that for your, paying your expenses on a monthly basis. So instead of putting that money somewhere that you don't earn anything, you put that money in annuities, and because it's an annuity, you get a series of payments. Okay, so here says recipient of annuity payments pay for the right to receive cash payments for the rest of their lives, life annuity, or set period of time, which is term annuity. So we have two types of annuity, term and annuity or life. The amount paid for this right is typically made with after-tax dollars. Therefore, what does it mean after-tax dollars? Again, I said, let's say life insurance. If you receive the life insurance, it's after tax and it's not taxable anyway. Anyway, so after tax. Therefore, portion of each annuity payment that comes from the previously taxed amount is not taxed again, right? These amounts are return of the recipient's previously taxed investment in the annuity. So that's a return of principal. It's not going to be taxed. The formula used to determine non-taxable portion of the annuity payment is as follows. Amount paid for the annuity divided by total expected return. So this amount paid for the annuity is after tax. So after tax payment, I mean a dollar amount out of total expected return gives you a ratio. That ratio multiplied by amount that you received this month or this year, that will be non-taxable.
So what happens to that money if the person dies?
Which money? This money then goes to, if there is no, goes to heirs, son, daughter, whoever is still alive. When computing the total expected return for life annuity, life expectancy tables are used. So let's see, do we have life expectancy tables? Again, I believe it should be something like the other life expectancy table. So that's what they're gonna use. So there's an example. Last year, Sally purchased life annuity for $72,000. So let's say this came from somewhere, after tax, 72,000, they buy an annuity. The annuity pays equal annual installment of $8,000 beginning January 1st of current year. Sally's life expectancy is 12 years. She computes the taxable portion of each payment as follows. Investment in contract is 72,000. Expected return is 12 years times 8,000, right? That's total expected return. So 72 out of 96 gives you a ratio of 75%. So 75% is excluded. Amount received this year is 8,000. 75% of 8,000 exclusion. That means taxable amount is only 2,000 that goes in the tax. Okay, Social Security. Of course, you can read this, but it's gonna be a long story to read. So instead of reading this, you can read yourself. You can stop the recording if you like, if you are watching the recording. You can read it, but let me, instead of spending time in here, let me get an example. Again, I'm constantly mentioning examples because that's the best way you can learn. It's a problem given to you and the solution is given to you. So what else you want, right? Here, it says Derek May is unmarried. His adjusted gross income is $31,500. So be careful here. We are going to get it done all the steps. So be sharp here. Not including $13,500 of Social Security benefit. So that's $31,500. It's not including $13,500 of Social Security. Derek also has $3,500 of tax exempt interest. Tax exempt interest is here. You see you have tax exempt interest in here, right? And taxable interest goes right there. Make sense? And where do you report all these tax exempt interest, qualified dividend, ordinary dividend, taxable interest? Where do you show all this? In Schedule B. You see in Schedule B, you have interest at the top. You put bank names and interest amount, and then ordinary dividend goes here. So that's Schedule B. Anyway, so step one. If you have a software, we'll do it for you, so don't panic. But if you want to take a multiple choice question, enrolled agent exam, something like that, somehow you have to learn this at least for a week till you get that exam done. After that, if you forget, just like I do every time, that's fine, because software will do it for you. But before exam, you have to learn this. So here, AGI before Social Security is 31,500. 50% of Social Security that you have, you add it to it. Okay, that's 6,750. Plus tax exempt interest, you add that also to that. So we are adding AGI before Social Security, half of Social Security, and tax exempt interest to get to a point that we call it modified AGI. Modified AGI. Modified AGI, it will be used in different situations. So this is, get used to it, modified AGI. Now, for the Social Security, the IRS gives you a base amount. As you remember, we have standard deduction in 1040, something like that. So standard deduction base amount, it says, if you are married filing jointly, use 32,000. If you are married filing separately, sorry, use 0. And 25,000 for others, like single or head of household or something. Okay, so because it is single, we're gonna use 25,000. So far, so good. That's standard deduction for Social Security calculation. So excess modified AGI is 16,750. Everyone is with me so far, so good? Now, 50% of excess modified AGI is 8,375. Now, step 8. Tentative taxable Social Security benefit is the lesser of line 2, which is 6,750, or line 7, which is 50% of modified AGI. Which one is less? That is your tentative taxable Social Security, 6,750. And that taxable Social Security goes somewhere here. You see, taxable amount for line 6A, Social Security. So Social Security benefit in 6A will be 13,500. Taxable will be 6,750 based on that calculation. But still, that's tentative, okay? Don't get excited here. Now, if modified AGI does not exceed the threshold amount, which is 44 for married filing jointly, 0 for married filing separately, and 34 for all others, that's the threshold. If it does not exceed that threshold, the amount on line A equals to the taxable Social Security benefit. If modified AGI exceed the threshold amount, the following calculations are still required. So you are not done yet. So if your modified AGI exceed that threshold, you have to do the tax. So here, modified AGI, I highlighted that already. It is 41,750, and this is a single person. So 40,750 is more than 34,000, right? So it is above that. That means line 8 is not over yet. We still keep going. We go to line 9. It says the lesser of the amount from line 8 or set amount, 6,000 married filing jointly, 0 for my married filing separately, and 4,500 for all others. The lesser of 6,750 or 4,500. So the lesser of 6,750 or 4,500. So we choose the lesser, okay? Plus 85% of whatever it's above the threshold. So $4,500 is taxable, but 85% of whatever is above the threshold. So 41,750 minus 34,000 threshold for a single person, it is 6,588. That's 85% of that. So 41,000 minus 34,000 times 85%. That's 6,588. Now add them up. 4,500 plus 6,588. It gives you 11,088. Now you go to line 12. 85% of Social Security benefit right at the beginning. Remember Social Security benefit here? How much is, because that's the maximum they're gonna tax you on that. So 85% of that is 11,475. So which one is lesser? 1188 is lesser or 11,475 is lesser? So 1188 is lesser. We're gonna choose that. So lesser of that or this. So the maximum you get taxed on your Social Security, the short answer is either 50% or 85%. Maximum is 85%. So in this situation, you didn't get to that 11,475 because 1188 is lesser, so you're going to choose that and case closed. That's it. So far, so good on this? How do you want to memorize it for it?
Is this a special form that you'll fill out somewhere? It'll be a schedule?
It's worksheet.
It's what? It's a worksheet? that's
Worksheet.
in the-
But you don't do it manually, your software will do it for you. But just the concept.
Yeah.
If you ask me this next week, I don't remember anymore. But the point is just to understand kind of, okay, there is a calculation. I remember it's a 50% of Social Security or 85% max. That's all you can get taxed. So here you see, here is 50% of AGI, line 7, or 50% of Social Security. And that was 6,750. We went with the 50% of Social Security. And it was tentative until we realized this guy has a modified AGI above the threshold. So we end up by calculating more because his AGI is higher. But most of your tax client, they don't have that much high AGI. Most of them, they have just regular Social Security.
So when we do the lead, or just the final test, like the exams, do we have forms to refer to when we have to figure this stuff out, or are we doing it in the software?
For VITA program
Just whatever.
or my class?
Yeah, for the.
In my class, I'm not gonna test you on this.
Oh,
But enrolled agent exam, if you want to become enrolled agent, they will. You might get one question or two, maybe one or two in regards to Social Security. In one of them, you might need to do this. most of the times they're not gonna give you this much complicated one. They give you a little bit easier one, because it's a multiple choice and you have 3 minutes time to do it. So it will be not that much hard. This one, you see, line 8 was done, right? But just we realized, okay, wait a moment, the AGI is, modified AGI is higher than the base. So that's why we end up by going further. But here says, same fact as example 17, except Derek is married and filed a joint return with his wife. Okay, so one more time. AGI before Social Security was 31.5. 50% of Social Security benefit that normally will be taxed is 6,750. Tax exempt interest is 3,500. All of a sudden, we have modified AGI of 41,750. So far, so good. Just like before, right? Same thing. But now he's married, okay? Less base amount for married is 32. So 41 minus 32, excess modified AGI is 9,750. Here, a excess modified AGI was 16,750 because 25,000 was the standard deduction. But here is standard deduction. Social Security standard deduction is 32,000, so it's much bigger. That's why modified AGI is 9,750. Now, 50% of modified AGI is 4,875. So tentative taxable Social Security benefit is lesser of 50% of modified AGI or 50% of Social Security. Which one is less? So 50% of modified AGI is less, we go with the less. So 4,875 is the answer. It says because it's not over the modified AGI is not exceeding the limitation threshold, we're not gonna go and do the rest of the calculation in line 10, 11, 12, 13. We're just gonna stop at line 8, that's it, case closed. And you see that 4,875 goes in the Form 10 form. Okay, so that's good enough up to here, Social Security. We will continue the rest later on. It will be recording available to you in Canvas if you want to watch it again. And I will try also to upload in YouTube so everyone on this planet can use it. Okay, have a good day. Thank you so much.